Hi everyone, this is Demo Gonzalez of Heartwood Financial Services. Hey, thanks for joining us for our latest market update and outlook video. Now, if you're like me, you've been watching the news and it's been a little stressful lately, right? We've been seeing missiles flying over from Iran into Israel. The election stuff is really starting to heat up. There's a lot of tension out there. And so what I want to talk about in the video is answer the questions of how this geopolitical stuff especially is going to affect the markets, and could it derail the markets, and what are the things that we need to be focusing on to see if that could actually make a big impact. Okay, and there's a lot of other things going on too with the economy and the Fed, so we're going to get into that as well. And also I'm going to talk about a little change that I've been making in my thinking with what's going on with the economy and how that's going to affect the portfolio. So you have to stay tuned till the end to get to that. But thanks, and let's get started. All right, as always, we like to get started with the asset class returns for the month of September. So again, the month is in the blue, the year to date is in the green. So thanks to the potential for a soft landing going up and inflation quieting down a little bit and the Fed starting to cut rates. We're going to be talking a lot about this in the update here. We've had a nice continuation of the market rally so far. Large cap was up, small cap was up. Now small cap didn't go up as much as large cap, but for the quarter, because a couple months ago small cap had this huge run, so the quarter small cap actually did better than large cap. And real estate has been doing really well, up 3.3%. Even international, especially emerging markets. You know, there's some news out of China that we're going to talk a little bit about as well in the update. But bonds did pretty good. The riskier bonds did a little bit better than the more conservative bonds, but they all did pretty good. That's not a bad 1 month return. And then commodities, pretty much across the board, everything was up. Gold's been doing very well. That's part of the commodity complex. But oil actually went up a little bit as well. And so we've seen what's been going on with the tensions in the Middle East. And so that's been adding a little bit to the price of oil recently as well. So let's dig more into what's going on. All right, so before we jump into what's been going on with the geopolitics and how that potentially could derail the rally, let's give the context of what's been going on for the month of September. The market started with a nice little bump up when the Fed finally went ahead and cut rates. We've been talking about this for about a year. They've been talking about it. They've been thinking about it. They finally pulled the trigger. And instead of doing the 25 basis points or 0.25%, which is what most people expected, including myself, they went ahead and did 50 basis points, which is 0.5%. And so what that tells me is that the Fed is starting to feel pretty confident that inflation is coming down and it's going to continue to go down. And now they want to work a little bit harder on making sure the economy doesn't slow down too much. And that actually is very, very good news, because I've been talking about how the economy is slowing down and are we going to go into a recession or not. So this is actually a great sign and improves the probabilities of not having a recession, because we seem to have a very proactive Fed. Great news. And so why has the Fed been able to cut rates? Well, it's because inflation has been coming down. So real quick, the PCE inflation report, which is, again, the favorite report for the Fed, came out just about a week or so ago, and it came out at 0.1% for the month. So think about that. If you turn that into a full year, that's only 1.2% inflation. That actually sounds really great. It brought down the year-over-year number to 2.2, and the expectation was for 2.3. So again, things are going more in line with what the Fed was hoping for. They have a target of 2%, and we're at 2.2. That's pretty good. All right, and then last week there was this big news that came from the Chinese government that they're going to be acting in a more stimulative way for their economy. They're doing a whole slew of things. They're lowering their reserve requirements for the banks so they can lend more money. They're cutting the amount of down payments for real estate. They're expanding their real estate market to more foreigners. All kinds of things that they're doing to try to stimulate their economy. As you've seen from the asset class returns, emerging markets has been a pretty bad performing sector for the stock market. And so China's been one of the big reasons. They've been in the doldrums pretty much ever since the pandemic. And so they're trying to move their economy back in a positive direction. Is it going to work? I don't know. I'm still a little skeptical. They still got some pretty big issues. And this was not the big fiscal bazooka that a lot of folks thought that they needed to do. But it's definitely going to help. And I would note that when you have the Federal Reserve lowering interest rates, you'll notice that it gives some breathing room for other countries to actually do stimulus as well. So it wouldn't surprise me if you see some other countries start to do some stimulus like what you've seen here in China, because the Fed is now kind of making it easier for them to do it. All right, finally, so how does the Iran missile strike going to affect the markets? Well, there's always going to be an effect, and the biggest way that it can have an effect is that it affects the oil markets. The energy is priced into all kinds of things in our economy, and so when oil prices go up, it can create inflationary headwinds. It can create all kinds of havoc. And so far, this seems like a little bit of a repeat of what we saw in April when Iran, launched a bunch of missiles over to Israel and they shot them down for the most part. And it looks like the same thing happened again here. Now, there was a little bit of an escalation by them sending ballistic missiles this time, which are a little faster, a little bit more dangerous. But again, they shot them pretty much all down. Is Israel going to have a retaliation? Probably. The big question is, are they going to retaliate and hit some of the refineries or some of their ports where they ship out the oil? That's where it can really make a difference to the markets. But so far, they haven't done anything. And if it's like last time, they're going to, retaliate, but they're going to try not to escalate. And so I hope that is what we see again. Obviously, this is something to keep a very close eye on. But for the moment, I don't feel like this is enough at the time to derail what we're seeing in the improvement here in the economy, and now with the Fed creating a tailwind for the market. All right, real quick, let me go over some of the economic numbers. I always like to talk about that, especially since we're more focused on the economy and growth than inflation here in the last month or two, and probably going forward. So on the manufacturing side, things continue to be pretty slow. The ISM manufacturing number came out at 47.2, basically a break even from last month. So that's not really getting any better. But then when you look at the ISM services number, it came out at 54.9, actually higher than the previous month. That shows that the services economy is actually expanding. Now, a 50 means that it's expanding, but it went up even more than was the expected number and more than the previous month. And then we're seeing the initial claims, which is how much people are actually looking for unemployment, their unemployment benefits. The initial claims has been coming down as well. It's been kind of in this 250 range over the summer, and the last couple weeks it's been at the 220 range. So it almost looks like labor is getting better. And just this morning we got the BLS report, which is the big report we get about employment here for the month of September. It showed that we had 254,000 new jobs, which was way more than everybody was expecting at around 140 or so. And unemployment went down to 4.1 instead of going up. So it looks like maybe things have stopped going down and they're starting to settle. Now, this is a 1 month report. Things can, slip again for next month, but it's a very promising sign that maybe what we saw over the summer was the trough of the slowdown? We shall see. All right, real quick financial education moment. I saw this little chart and I thought it was very good, very timely. And basically, the problem that us as investors run into is when we try to time the market, we try to outguess what's going on with the economy and the marketplace. We tend to act in ways that don't help us. As you can see here, this is a study done by Dalbar. They've been doing this study now for 30 years. So I got the latest numbers here, and you can see that the average equity fund investor, the folks that buy mutual funds and sell and do all the trading, they've actually done themselves a disservice by doing all their market timing, because their return is 8% versus about 10% for the S&P 500. And so they're losing about 2% returns from, their behaviors and how they invest. And so in a dollar terms, you can see that that's like $800,000 difference in growth over that 30-year period. So it makes quite a difference. And so that's why it's so important to have a strategy, have a discipline, stick to it, and if you need help with that, find somebody that can help you with that. That's something that I try to do for my clients, to bring a third-party objective point of view when it comes to their investment portfolio. All right. I am finally warming up to the idea that maybe we're not going to have a recession, we won't have a hard landing, and it's going to be a soft landing. That's why I got the Grinch here. If you remember the scene where his heart grew bigger and bigger, starting to become a believer in Christmas. I'm starting to become a believer in the soft landing. So let's talk about a few points that explains why I'm thinking that way. All right, so here is exhibit 1 for why I think we have a good chance of a soft landing and a continuation of the market rally. When the Fed starts to cut rates over the next 2 years, okay, you have seen more often than not the stock market go up and go up in a pretty healthy way. You can see these are several different examples of time going out 2 years where the market was up quite nicely, positively, after the first cut from the Fed. Now, there were a couple times when that didn't happen in the stock market, 2007, 2001, and those scenarios were a little different because we were heading into recessions and the Fed was cutting rates in a reactive fashion to try to head off the recession from getting too bad. And so it doesn't look like that's the case now. Again, we don't know these things until, later, but it looks like we're going to have more of one of these situations up here. It's also pretty good for the bond market, as you can see here. And in pretty much every case, once you get the first cut, the bond market does pretty well in a positive fashion over the next 2 years. All right, so now if we get a little bit more granular here and look at the stock market and divide it into small caps and large caps, you can see that when the Fed starts to cut rates, it actually is even more positive for small cap stocks than for large cap stocks. Now, it's been positive for the most part for both, but even more for small caps. And it makes sense because small companies, they tend to have more debt. Okay, so when interest rates go down, that helps them more. And they tend to also have more floating rate debt, meaning that they don't lock in those low rates like a lot of the big companies do because they're borrowing from banks and whatnot. And so those rates will go up when interest rates go up, and then they'll go down when interest rates go down. That helps them be more profitable. So this is another thing that I'm going to be talking about in the implications of starting to shift a little bit more to the small caps to take advantage of this. Here's another little piece of proof that shows the improvement of earnings over the next quarter or so, and that's partially because we're seeing their interest rates go down, make it a little bit easier for smaller companies. So you can see that the estimates that analysts have here, this came from FactSet, shows that earnings for small cap companies will be 20%, and you have large companies at 15%. And this is a big difference from where it was previously. And so you got these cheap stocks that generally do well when interest rates go down, and are going to show much better earnings than they have in quite a while. So that's a pretty good setup there, as you can see, for small caps. All right, and then the last point here is the question that sometimes I ask myself, and I do get from clients from time to time, is, all right, Demo, the market is pretty high now. So how can you expect even more gains going forward? In other words, a soft landing with a continuation of the rally. Well, here is an interesting little nuance that, unless you live and breathe this stuff, you don't necessarily see. The stock market is expensive as a whole. So you can see here, right now the stock market's trading at about a 21.5 times price to earnings, which is higher than normal, right? At a 130% higher than normal. But if you were to just take out the top 10 stocks, which are all listed below here if you want to see that, the top 10 stocks are trading at about 30.5 times, which is about 150% higher, and they're making up a really big part of that S&P 500. So that other 490 stocks are actually trading at about 18 times earnings. Now it's still a little higher than normal, but not nearly as high at 117 times, or 117%, sorry, of their average. And so there's a little room for the remaining stocks to maybe play a little catch up, or maybe for the top 10 stocks to come back down a little bit. We'll have to see. I'm more in the camp that the top 10 stocks will maybe stay around the same, and the remaining stocks will maybe catch up a little bit. Now, this is just in the S&P. When we talk about mid caps and small caps, it's even more dramatic, okay, like we just talked about before. All right, and now the Heartwood implications. Right now, I am a cautious bull. Like you saw the Grinch warming up his heart, or making his heart grow. I am starting to warm up to the idea that maybe this economy will avoid a recession, will have a soft landing. Now, I'm still not completely on that, and of course, Ed is going to be tough to do until you see more data. But I'm starting to move a little bit more into stocks, specifically the small companies. I'm shifting a little bit more from the value style to the more growth style. In other words, going to more of those 490 stocks like we talked about a moment ago instead of the top 10. And in the bond market, I'm not changing the total amount of bonds. I'm kind of keeping that as a little hedge against the what ifs, and the geopolitics and stuff like that. But I'm ratcheting up the risk just a little bit in the bonds from cash, and the other I'm taking and adding to floating rate bonds that have a little bit more risk but a little bit higher yield. I'm going out of those really long-term treasuries, lowering that a little bit and adding a little bit more to the corporate bonds where you have a little bit more credit risk but higher yields. And again, lowering the cash, because we're going to see cash rates start to come down as the Fed keeps lowering rates. They just lowered 0.5, and so you're going to see money market rates go down, and they're going to probably lower again in November and December. So we definitely want to start to lock in those nice yields, which is what we're doing there. All right. So I hope that makes sense. I hope I answered any questions that you have. Please reach out if you do have any questions or you'd like a little bit more of an explanation. But thanks for watching. If you hung in there for this whole video, I really appreciate it. And please feel free to share the video with your friends and family. And of course, as always, God bless. Bye-bye.